Welcome back to A Random Talk Down Quant Street. This series takes you behind the scenes of quant investing, breaking down complex ideas and tackling the questions you've been dying to ask. Jeroen, welcome back to the series.
Thank you.
Now, I'd imagine that, as we all know, different investors have different levels of risk appetite. So how does that degree, that appetite, determine their use of active quant strategies?
Yeah, so this is also a bit a relative game indeed. So some investors don't mind active risk. They want it as risky as possible because they want the returns. They often use active quant as a lower risk opportunity. We don't use low risk, but if you look at the risk constraints, then it's less risky than fundamental managers. And if you're a bit more risk averse, you want to stay close to the benchmark, then active quant can also be a good option to add that bit of extra return. But then, yeah, we stay within certain limits. We don't have big over-underweights on individual stocks. So it's really risk controlled. You get the same risk profile as the benchmark and a little bit on top. So that's also from two perspectives. I think you can use it.
Now, going back to the example of an investor with a fundamental exposure and as an asset allocator trying to make a decision on where to allocate funds, how would an active quant strategy complement that fundamental approach?
Yeah, usually fundamental managers have their own style, right? And active quant is really a core approach. So we have multiple signals in there, but the end result is really core and stable, I would say. And this often complements the more volatile fundamental strategies. So you see that fundamental strategies outperform in certain market environments, and we give a nice stable addition to that. So we also outperform in other market environments. The excess return correlation, as we say, is very low. So you get a more stable, more diversified return pattern.
So a better composite as it's put together.
Indeed, yes.
And for those investors with a fully passive approach, this might be sort of a next step, taking the active quant approach. What's your observation there?
Yeah, so the first step up is usually enhanced indexing, and then after that you get more active quant. So it's a matter of tracking error. How much do you deviate from the benchmark? And active quant is also, it's still risk controlled. It's really in between that passive approach and that fundamental approach. So if you want a bit more risk, if you want a bit more bang for your buck, then active quant is really an approach you should consider.
So from everything you've said, it's very clear that every investor is different. Every client is different in terms of their needs, appetites, objectives. So what is it that you can offer in this world of individuality?
Yeah, so customization we're talking here now is also really a strong point of quant investing. So you can customize on different elements. Risk return, you can do it a little bit. Different universe. We have a stock selection model that works in all different kind of markets. And also from a sustainability perspective, still an important element, of course. If you add sustainability to your portfolio, it's already an active decision. Even if you do it in a passive approach, you generate some deviation from the benchmark. And then it's smarter to do it in an integrated approach like active quant, because then you can integrate as much sustainability as you want. You can really customize this. And you can also tilt your portfolios to these signals that you know that generate outperformance over time. So you also tilt your portfolio in the right way from a risk and return perspective.
Jeroen, thank you.
Thank you.
Well, thanks for listening to us. Next up, we chat to Jeroen again as we discuss performance. What kind of returns can we expect from active quant? Stay tuned.